Welcome to Stock Wars. This battle between dividend stock combatants will determine who seizes galactic supremacy and is the most attractive communications company going forward. The first Stock Wars combatant is AT&T. The company was formerly known as SBC Communications and changed its name to AT&T in November 2005. AT&T was incorporated in 1983 and is based in Dallas, Texas. AT&T provides telecommunications, media, and technology services worldwide. The company operates through four segments: Communications, Warner Media, Latin America, and Xandr. The Communications segment provides wireless and wirecom telecom, video, and broadband and internet services, video entertainment services using satellite, IP-based, and streaming options, and audio programming services under the AT&T Cricket, AT&T Prepaid, and DirecTV brands to residential and business customers. The second combatant is Verizon. The company was formerly known as Bell Atlantic Corporation and changed its name to Verizon Communications in June 2000. Verizon Communications was founded in 1983 and is headquartered in New York City. Verizon offers communications, information, and entertainment products and services to consumers, businesses, and government entities worldwide. Its consumer segment provides postpaid and prepaid service plans, internet access on notebook computers and tablets, wireless equipment including smartphones and other handsets, and wireless-enabled internet devices such as tablets, laptop computers, and netbooks, and other wireless-enabled connected devices such as smartwatches and other wearables. Let the battle begin. AT&T is currently trading at $27.82 and is down over 25% year-to-date. Over the last 5 years, AT&T is down over 16%. Verizon, our other communications giant, which is trading at $57.96, is down this year, seeing a decrease of a little less than 6%. With that said, Verizon is up over 24% during the last 5 years. Now let's take a look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it is an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, AT&T is the smaller company with $201 billion compared to $237 billion for Verizon. Both are impressive communications corporations, but Verizon takes the first metrics comparison in this Stock Wars battle with $36 billion more in market cap. The second Stock Wars metric comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who generates more revenue in this epic Stock Wars showdown? In 2019, AT&T had $181.3 billion in revenue, while Verizon came in at $131.8 billion in revenue. AT&T wins the second metric in this battle against Verizon. The third metric comparison in Stock Wars is further down on the income statement. Net income or profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. For the third metric in this Stock Wars battle, Verizon takes the win with $19.2 billion in profit, while AT&T comes in at $13.9 billion. Knowing the profit for each combatant transitions into the next metric in this stock wars comparison: profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or business activity makes money. It represents what percentage of sales has turned into profits. AT&T comes in with a profit margin of 7.66%, while Verizon is at 14.57%. For the third of the first four metrics, Verizon wins. Both corporations have decent profit margins for telecommunications companies, but Verizon nearly doubles up AT&T. As the stock wars rage and Verizon maintains a 3-1 lead in this battle, the fifth metric is in sight: 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding or contracting. AT&T comes in with a 3-year revenue growth of negative 2.3%, while Verizon wins again with a 3-year revenue increase of a meager 1.1%. As the two titans battle for communications dominance, PE ratio emerges as the sixth metric in stock wars. The price-to-earnings ratio is the ratio for valuing a company that measures its current share price relative to its per-share earnings. The price-to-earnings ratio is also sometimes known as the price multiple or the earnings multiple. When examining the forward PE, AT&T comes in with a metric of 8.72, while Verizon boasts a forward PE of 11.76. AT&T comes out on top for the second time in this stock wars matchup as the battle rages between these communications juggernauts. Dividend yield is the next metric comparison in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. AT&T comes in with a very high dividend yield of 7.36%. Verizon, on the other hand, is at a lower 4.38% yield. For the third time, AT&T wins another metric. Both yields are relatively high. Continuing on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that record. When analyzing the two combatants, AT&T boasts 36 years of dividend growth, while Verizon comes in with a respectable 14 years of consecutive increases. In this metrics battle, the dividend aristocrat AT&T comes out on top. Now on to the 5-year dividend growth, which is the next metric in this stock wars battle between these industry leaders of the communications sector. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase the dividends paid to their investors on a regular basis. According to Fidelity, AT&T has a 5-year dividend growth rate of 2.04% compared to Verizon at 2.12%. Once again, Verizon claims the metric in this stock wars matchup. This begs the question for the next metric: how safe are the dividends? The Dividend Safety score system takes into account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, AT&T has a score of 65, which is considered safe. On the other side of this matchup, Verizon has a score of 87, which is considered very safe. Verizon is the victor of this stock wars metric. The 11th metric in this stock wars contest also reflects on dividend safety: the payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays to shareholders in the form of dividends. This is expressed as a percentage of the company's total earnings. Currently, AT&T's payout ratio is 65.17%, while Verizon is at 54.33%. Both payout ratios are respectable, but Verizon is the winner of this stock wars metric. Moving on quickly to the 12th metric, the two communications sector giants will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on the balance sheet to satisfy its current debt and other payables. AT&T clocks in with a current ratio of 0.81. Verizon, on the other hand, sees a current ratio at 0.96. The higher the current ratio, the better. Therefore, Verizon takes this stock wars metric with a slightly higher current ratio. The next metric is the debt-to-equity ratio in this stock wars contest. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of a company's financial statements. AT&T sees a debt-to-equity ratio of 1.09 and Verizon comes in at 2.14. While both are over 0.5, which means their assets are heavily financed by debt, AT&T gets the better of this metric and wins another one. In this stock wars battle, Verizon won 8 metrics compared to AT&T, who won 5. Verizon is the winner of this epic stock wars battle of these communications sector giants. Verizon wins the overall stock wars battle from a metric standpoint, but both companies are pretty accurately priced here in the current market. Some investors may see value here and add to their telecommunications sector holdings. That being said, many are concerned by AT&T's continued debt issues and ownership of DirecTV. Verizon offers a more pure play into the upcoming 5G market. If you are interested in a deep dive into Verizon or AT&T, please check out recent videos from my colleagues Stock Ninja and Hidden Freedom Investing. I'll leave a link in the description to their deep dive videos. If you missed the first 3 episodes of Stock Wars matchups between ExxonMobil and Chevron, JP Morgan and Bank of America, and Lowe's and Home Depot, I'll leave links in the description for each of those videos. Stay tuned for future Stock Wars episodes, and please like, subscribe, and turn on the bell notification so you don't miss any future episodes. Comment below if there is a particular battle you'd like to see. Until next time, remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.